Come and fill up. My name is Guy Newey. I'm head of Environment and Energy at Policy Exchange, and welcome to this event on reforming the carbon market. In all the focus or policy focus on electricity market reform, Green Deal, renewable energy subsidies, the ETS, at least in the UK, has been rather neglected in recent years. Of course, part of this has been due to the wearing effect of criticisms about ETS, over-allocation of permits, the carbon price, failure to stimulate investment, as well as some distracting accusations of fraud. However, for organisations like Policy Exchange, who are focused on cost-effective decarbonisation, it remains a potentially vital tool. In our most recent report on the policy implications of shale gas, there are copies at the back, or there were copies at the back, I may well have gone. We call for improvements to the ETS, such as a 15-year outlook on the cap, better banking and borrowing systems, and what you might think was a basic, but ensuring the cap is set in line with climate science. If a successful ETS or another carbon pricing mechanism is not in place, then sudden changes in the energy sector, such as shale gas, I think we'll all agree, risk derailing efforts at decarbonisation. So in this debate today, we hope to consider some of the practical steps that are needed to improve the ETS, what policy pitfalls we should avoid, and what or might be getting in the way of progress and a better ETS. We have an outstanding panel, and indeed audience, to discuss these issues, and hopefully we'll have plenty of time for questions. The first speaker will be Professor Michael Grubb, who is a senior research associate at the University of Cambridge and has long bridged the divide between academia and climate policy. He's a former economist chief economist at the Carbon Trust, former chair of climate strategies, yes, still a non-exec director, and former board member of the Committee on Climate Change. He currently combines his Cambridge role with a sustainable energy advisor position at Ofgem. Christoph Balester is the principal advisor to the Polish Minister of Environment. He's a long-time energy specialist and worked across a range of European and national government positions linked to energy. This includes roles in DG Competition, DG Energy, where he dealt with coal, oil, and CCS policy. Etienne Alec is head of energy trading and sales for Europe, Middle East and Africa at JP Morgan. Before joining the bank in 2007, he previously worked at commodity arm of Bear Stearns, Callion and Total. He's got an incredibly long list of academic qualifications, including one in quantum physics. And as well as all this, he is also treasurer of the Chelsea and Westminster Swimming Club. The eagle-eyed amongst you will have noticed that there's been a last-minute change to the panel. Barry Gardner, the Labour MP, was due to appear, phoned on Saturday evening to tell us he could not make it today as, I quote, the committee had sent him to Azerbaijan. I presume this is some kind of euphemism, but we are delighted that Baroness Bryony Worthington could replace him at the last minute. Bryony is well known to many people working in this area. She's former Friends of the Earth campaigner, driving force behind the Climate Change Act, an advisor at SSE, and in 2008, was it, set up Sandbank? Which is a charity campaign for better functioning carbon markets, which is now up here in the House of Lords. As I said, each of our speakers will speak for about 5-7 minutes, and then we will open it up to hopefully around half an hour, 40 minutes of questions. So get them brewing. So I'll ask Michael to speak first.
Okay, thank you very much. Sounds like the microphone's working, and I have to congratulate Policy Exchange as well, actually, for both setting up the meeting, timely topic, and circulating a list of 5 quite prescient questions, which, believe it or not, I actually read and thought about, and to some extent have tried to structure my comments around them. Let me start just with a word of basics. The emissions trading scheme obviously was designed on the advice of long economic tradition to establish a cap on emissions and an associated price. I think we all know the theory about why that delivers an efficient outcome, achieving basically two principal objectives is the intent. One is to achieve a given cap on emissions at, in effect, a negotiated balance of environmental ambition and economic costs. And the other is to support low carbon investment, obviously to develop the infrastructural capacity and investment capital for successive rounds of emissions reduction. And easy to say with hindsight that maybe we didn't think carefully enough about those two objectives and the fact that they are not really all rolled into one. And that's the sort of theme that I want to take. Now, I would guess that it's a pretty well-informed audience. Most of you will have seen these wonderful wiggly lines of ETS prices, and they went like that, and they've gone like that, and they've gone like that. I did prepare a couple of slides. Now, actually, I've realised that one useful point to make about that is there's only one line, and that's quite a major achievement. If you think there's 27 countries, well actually 30. Imagine what the state of efforts on this issue and what it would be like for industry if there were 30 different carbon price lines across Europe of every country trying to muddle its own way through this kind of problem. So the fact that there's just one carbon price across Europe is itself really quite a major achievement, particularly when you actually look at the 60 years that we've spent trying to build an integrated energy market across Europe. And the still distinctly incomplete venture of that. So this is actually quite something unusual, and as observed in the conversation, ironically now with the system moving to auctioning, it's actually also the closest thing that we actually have to a common fiscal instrument that negotiated across Europe whilst the revenues come to member states. Some people may think that's not necessarily a good thing, but it is, I think, a factual observation about the nature and depth of the innovation implied by the ETS. In terms of good and bad, in addition to that, has it cut emissions? Well, yes, it has. We recently Climate Strategy did a review of academic literature, which basically estimates a pretty wide range of uncertainty, but somewhere between 30 and 100 million tonnes of CO2 a year, average, since the scheme's inception. That's between 2 and 5% roughly of the capped emissions. Now, 2 and 5, is it large, is it small? Well, actually, it's pretty big compared with almost any other individual environmental or climate instrument you can think of. So, obviously limited by the price collapses, the over-allocation, etc. The real difficulty is where we are now in the ETS, in terms of the price collapse that you all know about, is in a sense challenge both the objectives. The first one in the sense that it means where we are is a completely different balance of environmental ambition and economic cost than was actually intended in the original deal. I mean, it was all projected around carbon prices of around 30 euros or whatever. So I think there's a pretty strong case that one would need to look again, but more fundamentally still, talk to anybody in the industry and their reaction is, we can't invest against this, we don't have a clue what the price is going to be. We're lacking and losing confidence in the industry. Now, to think about the implications of that, I think one also needs to step back and recognise in Europe we have some rather big problems which are grabbing the headlines, quite rightly. Very serious, and clearly Europe has not actually yet struggled its way to working out solutions to the Eurozone crisis. What there has been is a major shift of the dialogue towards the need for stimulating growth. And that is the number one priority is how do you stimulate growth when actually governments are pretty broke? And the answer is, well, investment. Now, the interesting thing is when you look at the European energy roadmap over the next decade to deliver the kind of basic refurbishment that Europe needs of its energy system, it's looking up to €1 trillion of investment in the energy sector. Even just the UK, the figure is estimated by Ofgem at 200 billion. Now that is not a trivial amount of money. And believe me, it's not all going to come from government coffers. So we need to attract private investment. And the fundamental dilemma that Europe is facing is that private investment is saying, well, we know quite enough about climate science, policy, politics, fickleness, etc., that it would be dumb to put all our money into high carbon assets. But frankly, we can't possibly take a major low carbon project to the board and say, invest $1 billion in this because there's going to be a carbon price, trust us, it's going to be high. It just doesn't work. So the private capital, of which there are vast amounts around, is currently steering clear of the European energy sector. That is the fundamental problem that Europe has to fix. I don't have a lot of time to go into the details, and I'm not pretending that reform of ETS would be the only instrument to achieve that, but it could be a pretty important one. In terms of what most fundamentally needs to be done, you may know that I was a lead author on a report for climate strategies that came out about 3 months ago. It's called Strengthening the ETS, Creating a Stable Platform for EU Energy Sector Investment. And it did say there's no one easy fix here. There is a strong case to set aside some allowances because the system is so far out of kilter from what was originally intended. Clearly, we need negotiations on post-2020. Very strong theme, talks to any major industrial investor. But in addition, both the credibility and assurance requires something else in there to set a carbon price floor. That's a logic which has already been worked through in the UK, and at the EU ETS, it's actually extraordinarily easy to achieve now because we have an option that did not previously exist. EU ETS in phase 3 moves to about 60% or more auctioning, and then simply needs to establish, negotiate, pretending that's politically easy, but negotiate a reserve price on future auctions is the obvious mechanism which would then de facto set a carbon floor price in Europe, which would be a real underpinning to reduce the downside risk for any low carbon investors. Moreover, if that floor price were rising over time, then people would incline to buy from the auctions earlier rather than later, which would mean that rather than deferring auctions and revenues, which is the kind of current proposal that's on the table, the incentive would be to buy from the auctions early and then also help to bring in some revenue, both for public revenue purposes but also for investment in innovation, which, as any of the major sectors under the ETS say, is crucially important strategically and does require some public support in innovation. So basically that was the sort of conclusions of our study. Not easy, not pretending it is. It's become quite a political issue. But if we're serious in getting investment in European energy sector and channeled in a direction which is consistent with all we know about climate science, that seems to me, and I think a number of my colleagues now, as the way that Europe needs to go.
That's great. Chris?
Thank you. Let me thank you first for inviting me over. I think it's always useful to sort of prove to people in London and in Poland we don't sort of only say no, but we also could be constructive, especially on climate policy. I agree on many points with Michael on ETS, especially the cap and trade nature of ETS is such that it's designed to reduce emissions at the lowest possible cost. And it works. It works, and therefore we in Poland think that it's good for the industry that it works at the lowest possible level. So we could stay an industrial country. Of course, there's always a hint in ETS that it should stimulate investment. Should it, or should it reduce emissions at the lowest cost? Because these two things are mutually exclusive. We think that it should reduce emissions at the lowest cost. And if it does, then even the cost could be even lower, because at this stage ETS is not implemented fully. There is still Article 10C. I guess you all know ETS here. You could still reduce emissions in the power sectors of new member states. For example, in Poland, we applied for the transition period to the European Commission. The deal is that you could have a certain amount of free allocation in the power sector instead of auctioning, but you have to commit the power sector to investment in, to reduce emissions. And say in Poland, the investment program is evaluated at 50 billion euro. So that's the amount that will be invested to reduce emissions. You could calculate in certain models how much it will affect the price. There is also Article 24A, not going into specifics, but basically it enables offsetting emissions reductions outside of the ETS and calculating these offsets in the ETS. So there is still possible to reduce emissions that is cheap and reduce emissions, because this is the objective of ETS, and at cheapest cost than ETS. So first we have to implement ETS fully, but then of course we recognize that the ETS was designed sort of in such a way that it brings quite a few problems on board. It's not stable, but that's part of the game of the market system. You know, the price goes up and down, and that's what our friends in the financial sector benefit from. If it stays low, then there's no benefit for you, I'm afraid. Of course, if we introduce a floor price, of course, taking into consideration that the market is always looking for ways to adapt and find the cheapest ways to do that, my prediction is the price of allowances will be always at the floor. So why doing it? Why not to introduce a tax? Tax is brilliant. Tax is not, has a sort of market character, so we could be predictable for all sectors. We say, that's our target, this is the price, the industry should sort of adapt to it, there's a predictability, but of course, we will never agree a tax in the European Union. And I think that the UK will be one of the countries against it. So ETS is sort of the next best thing. So we have to implement it fully, and then think how to adjust it so it stimulates investments and it still reduces emissions at the affordable price. In Poland, we think that best ideas are including more sectors under the ETS, because it's very selective at this stage. It covers only 40% of emissions in the EU. So say, an example of electric cars. Do you want to stimulate electric cars? But suppliers of electricity to power electric cars are covered by the ETS. Personal cars are not. So there is a competition thing here. So we should sort of include more sectors to stabilize the system. We should also invite more countries and work towards including more countries under the system to at least mitigate a carbon leakage problem. European countries in Balkans would be the obvious target because they are members of energy community. Ukraine, very big potential of reducing carbon, and also a target for some of the companies to leak emissions. So that's another idea. I think there are a few more, but I don't want to sort of monopolize the discussion. Yeah, I think I'll pass over.
That's great, Christoph. I'm sure there'll be plenty to come back from what you mentioned.
So, you know, I represent JP Morgan, so we are a significant bank in the carbon market. We can and do deploy hundreds of millions of dollars, you know, at any sort of time in the carbon market. So we play a modest and powerful role. We play a modest role because really we are the recipient of policy decisions, and we adapt prices to what policymakers decide. And we play a powerful role because we actually deploy, we effect real economy projects. We invest in projects, or we support by buying CRs, or making markets on EUAs. We actually support the carbon market itself. So let me give you first, an overview of the kind of our activity in the carbon markets and the useful role that financial institutions play. So you've got the whole variety of things, but simply, we are a large investor in CDM projects. We own a company that we like very much, which is called Eco Securities, and we have a portfolio of our own at JP Morgan where we buy primary CRs from emerging markets, and then we import them into Europe and sell them into Japan. Seen another way, you can see the kind of from the commodity angle, where you say, those physical credits are effectively imported in Europe, but you can also say that it is money. It is money which is really taken, from utilities, let's say in Europe and Japan, and from large industrial, and which is redistributed into those emerging countries and sanctioned. And this process, which is a banking process, is effectively sanctioned by the United Nations. So that's one of the roles that we play, where we try to make this process of transfer to emerging markets as efficient as possible. Another role that we play is that there is a large surplus in phase 2 of EUAs, and a lot of companies really don't have a real need for those EUAs, until 2013, 2014, or beyond. So we provide liquidity. These are tradable assets, they're very liquid, we are ready to lend money against them, we can buy them now and sell them to you later, and we buy them for cash. So we provide to the market a very large liquidity service where we monetize assets which are not needed now, and we sell them forward so that the compliance buyers can have them when they need them. We also are very much at the center of the market when it comes to the carbon price as a price signal for the dispatching of power plants. And it is a major use of the carbon price today. So we provide hedging services. We buy, for example, the generation margin of coal-fired power plants for the years 2015 or 2016. And that implies to make a market for the carbon price in those years. We also sell, long strips of carbon to in size to utilities or some large users down to 2020. And the market is not very kind of liquid, for those maturities. So effectively, we make our calculations and we say, okay, we're ready to offer carbon to 2020 at that price. So you've got a whole, we make markets every day, on our trading desks. So you've got a lot of uses of financial institutions. As a principle, we take risk. We take delivery risk from Russian ERUs, from Chinese CRs in large industrial facilities, and we take the risk that those CRs are never going to show up from those industrial facilities. So we buy them as a principle with all these risks, and we sell them firm in Europe and Japan. So that's what we do, and in so doing, we actually deploy a very substantial amount of capital. Now, that gives me, if you want, a kind of an overview of all the policy decisions which are made. And every time there is a decision which is discussed, not even made, we, the market participants, are going to start interpreting those likely decisions, and we're going to kind of adjust prices accordingly. So to give you an example, if the set aside, let's say a decision is made to remove 1.4 billion ton of EUAs for the first years of the phase 3, but then there is no decision to remove from the whole of the phase 3. Does it move the price? Not really. What is going to happen is people effectively are going to need, there's going to be a relative shortage of EUAs in the first, few years, let's say 2013, 14, 15. But those EUAs are going to come back in the later years. So what am I going to do? Well, I'm going to flatten the curve. I'm going to increase the value of EUAs in 2013 versus the value of EUAs in 2020. Because the liquidity need, expressed by the market will be less, and so I will adjust prices accordingly. So what are the consequences of all these decisions which are made on a day-to-day basis? Well, today it's quite interesting because what do you have? You have a lot of subsidies to wind farms and solar panels, and investment has been booming in Germany, in Spain, in France, and so the electricity prices are really changing a lot. The big prices, let's say the price at noon in the summer is very low as what it used to be only 4 or 5 years ago, because you've got all these solar panels dispatching to the max. So with the current carbon price though very low, the coal-fired power plant in parallel are running also to the max, whereas the combined cycle are almost not running, or in some countries like Holland, only running during a few hours in the peak. So all these policy decisions which have been made have the following effect. Right now, the way the power assets are dispatched, you've got a very clean power, PV, solar and wind and hydro dispatched, very, very present. And then you've got the coal-fired power plant also dispatched, to a large extent, to the detriment of the gas-fired assets. And that is a direct consequence of all these decisions which have been made. So my message today is to say every policy decision has a very concrete impact on prices and on real life, because the market is going to dictate how we dispatch those assets. And we do that, and we actually dispatch power plants ourselves. So how can we improve the ETS? One is that, one first measure should be simple, is that policymakers should not shy away from intervening in the market. There's this idea, right, that it's bad and maybe, politicians shouldn't kind of meddle in the markets. Let me clarify. Central banks are in the market every day to a very large extent, and the market can live very well with that. So what the market participants don't like is chaotic intervention in the market, when one day some policymaker or politician makes a careful comment on what is going to be the course of action, how the supply and demand are going to be affected. But so from that, in that respect, what is lacking in Europe is really a well-defined governance, a set of rules, very much like a central bank, where that the governors are going to meet and they're going to discuss about supply and demand, and they're going then to make pronouncements about those things and how they're going to go into the market and affect those balances. But my message is policymakers shouldn't shy away from intervening in the market and having clear objectives and trying to adapt market prices to their objectives. What they should shy away from is doing that in a very disorganized manner, which kind of surprises market players and put them on the back foot, and then they don't trust policymakers in the fact that the market is too dangerous, it's too volatile. There are market events that we cannot predict. So that would be, my first and most important message. And to give you an idea, during the crisis, at the depth of the European crisis in Q4 of last year, at the beginning of this year, the best correlation of EUA prices was with the Italian 5-year CDS. So as the kind of bonds, Italian bonds were going down, the EUAs were going down, and the correlation was 85 to 90%. It was simple. The market was saying, the mechanism of the markets actually, the infrastructure is very good. But do we trust that the governance of this market is solid? That the European Commission, that member states are organized to make decisions on this market in an orderly fashion and fix it if it needs fixing? No, surely we don't. And the more we see the mess in Europe, the less confident we are, that policymakers will be able to step in and put that, on the right track. So as a financial institution, we like this market very much. We play objectively a very large role in it. We think this market has a lot of future. We think a lot of investment was made in infrastructure, and that's true both for the EU ETS and the CEM. It's frankly a lot of small details were well thought out, and that has allowed a lot of investment to be deployed in those markets. So we think that's a very, very positive thing. But the risk now is that by somewhat careless decisions, all this nice infrastructure is going to fall in disarray, because if there is not a clear incentive for us from the private sector to play in this market, we're going to withdraw. So let me give you an idea. If the market price of CRs is at 15, then there's a large incentive to make investments in China or India or emerging countries to reduce emissions. If the market price is at 4, let's say we make a margin, a gross margin, just to dispel any doubt, of 10%. When the market was at 15, the gross margin was 1.5 euro per ton, and then you can hire people, you can invest in software, you can originate deals in those countries to make sure that the investments are going to be made. When the market price is at 4, you think about a margin of 40 cents. You cannot do all that. It doesn't make any sense anymore. And you need to withdraw your investment because there's not enough margin in the market to say, to sustain that activity. And by the way, the cash flow to the Chinese developer has become completely negligible. So they're not going to make those investments anymore. So I think all the elements of all the infrastructure in the market is in place. You can do whatever you want. You can say, I'm going to increase the quota of CRs and EIUs importable into Europe, and I'm going to restrict the quota of EUAs. What are you going to do? You're going to push up the price of EUAs, the CRs are going to follow, and then you're going to have renewed investment in emerging countries. You could say, no, I want to see more abatement in Europe and less in China because they can do their own stuff. Fine, you don't import the quota of, you don't increase the quota of CRs, you restrict the supply of EUAs, the price is going to move up, and then you're going to have gas-fired power plants being dispatched at the expense of coal-fired power plants, and you're going to have some more abatement investments made in Europe. So I think there's all this infrastructure which is in place, and the biggest risk which we all face now is that give it another 4 or 5 years, and private sector players are going to say, well, we really deployed a lot of capital, we give it our best shot, we were successful, but then policymakers decided that it was not worth it anymore, and so we're going to follow their lead and kind of start paring down that investment because clearly that's not what is wanted by politicians.
Thank you very much, Etienne. You heard it here. Policymakers in the room, you should intervene in the market. You'll be delighted to know that.
Okay. Well, yes. As a surprised politician, I pick up from where you left off, Etienne. It's always the case in these debates. By the time you are the fourth person to speak, many of the things you wanted to say have already been said brilliantly and eloquently by the people who have spoken before you. But I will just try and say a few words from my perspective, both as director of Sandbag and as a member of the UK government, Parliament, I should say, not government. So Sandbag was set up, as I said, in 2008 at the start of phase 2 of the emissions trading scheme. The original conception behind it was that we would buy up tonnes from the market and cancel them, because we thought that was a very good way of offsetting and providing people with a personal action they could take, and companies indeed actions they could take to reduce the amount of CO2 that ends up in the atmosphere. But when we started out on that track, we quickly realised that this was a market that had a problem, and the problem was there were far too many allowances circulating. We did this through analysing the data. It's a very data-rich policy, this. It's one of its strengths. There are 11,000 installations across 27 member states, and each one has a data file attached to it of how much it's emitted, how many allowances it was given. Fantastic resource to explore, and that's what we started doing. We've put all of that data up on an interactive map on our website. You can visit it, search it, find your nearest polluter, see who's got the most permits. And we've been doing that now consistently since 2008. Each year we publish a report into the state of the ETS. And this year's report, Losing the Lead, came out just last week. We launched it in Brussels. For the fourth year running, we've highlighted the fact that this is a potentially fantastic policy, but just underperforming and being dragged down by an oversupply of allowances. And it is often said, oh, well, it's a market. But actually it's not a market, it's a regulated instrument that has market-based implementation. And that's a very important distinction, because often we hear, oh, but it's a market, it's just doing what markets do, leave it alone, shouldn't be interfered with. That's nonsense. It's not a market, it's a regulated instrument backed up by law, and politicians created it and politicians should manage it. And they're failing to do so at the moment, but I will come on to where I think there is hope that things are going to change. The other argument we often hear about not intervening is, oh well, we set our targets, we're simply meeting them more quickly because of the recession. Surely that's a good thing, and we shouldn't try and impose more costs on industry at a time when the recession is biting. Again, I'd say that may be true if those targets had been set with anything like a logic attached to them. They were all calculated on political terms based on projections. So we looked back in 2006 or whenever it was, we were setting these targets that now last out. They don't stop, by the way. These targets just keep rolling. There's no sunset clause in the directive. They were set at a time when Europe's economy was growing, and there was no reason to doubt that it would continue to grow. So targets were set in anticipation that with economic growth, emissions would continue to grow, and actually that's proved to be completely wrong. We went into a steep recession, we're not yet out of it, some countries are, the majority not. And so that future projection of how difficult we thought the targets would be is completely wrong now. And in our latest report, we estimate that this has led to approximately 3.1 billion tonnes of many allowances being created by this directive. Now, that's the scale of the challenge, and that's what we need to see removed from the system. Now, to get it back into anything like the sort of degree of scarcity that was imagined when it was first designed. And to those who say, oh, but we just meet the targets, we've got to make those targets in line with the science, not in line with what was believed to be politically acceptable or expedient at the time. And the science is only telling us one thing, and that's we need to move faster and we need to take on deeper cuts. So on to a sort of slightly hopeful part of what I wanted to say. There is a big challenge, but it is true that there are now more and more people who agree that there needs to be change. I was delighted to hear from our colleague, thank you for coming over here from Poland. We accept that there are issues. Each country in Europe has a different perspective on this policy because of the nature of their energy systems and the things, their own economies. But I think it's fair to say now that there's a growing consensus that it will be in the interest of everyone in Europe if we do move forward. And it's fantastic to hear constructive suggestions about how we can change the policy to make it more effective. And I think just a report back from Brussels last week, what we're expecting now within weeks actually are two things from the Commission. One is a proposal to reprofile the auction, and that they are likely to consult on potentially removing up to 1,200 permits from the system. Now, we don't think that's anything like enough, not removing them I should say, just reprofiling them so that the auctions occur later in the next phase. We don't think that's anything like enough, and anyone who's interested in rescuing this policy, we all need to be sending messages to our politicians and to our representatives in Europe that it's got to be at least we would say 1.4 billion, or actually we'd say it should be closer to 2 billion. That will come out, that will be consulted on, it will go through the usual round of consultation, we'll see where we land. And there'll also at the same time be a consultation document issued for a longer term solution. So this reprofiling of the auction is really a short-term fix. It's a way of holding the prices up, getting rid of some of the surplus, preventing these allowances from being sold continually for virtually no money, because Treasury's not happy about the fact that their projected incomes are nothing like what they were when they anticipated this scheme. The longer term fix also has to happen because, as we've heard from Etienne, the market will not be fooled. It will quite quickly see that these permits are just going to schedule to come back in at a later date if they're not cancelled. So in parallel, there's going to be a consultation on what the longer term fix should be, and a couple of ideas, and Michael's touched on some of them, for what we can actually do in that consultation process. I think we certainly could look at introducing some kind of floor price on the auction. That would have the effect of preventing more and more allowances flooding into a market that's already oversupplied. Another option, which I think has some merit, is that it relates to offsetting. And at the moment, one of the reasons we have this massive oversupply is because companies like Etienne's have been so successful at going out and finding really, really low cost abatement in other parts of the world and bringing them back and selling them, which is what you'd expect. But in a market which has almost got no demand in it, to have a supply of 1.7 billion tonnes of offsets, it really isn't helping. So what could happen in the future is, rather than put a price trigger on the general auction in the market, you could actually see the offsetting regulations change so that they only become accessible if the market price is clearing at a certain level. So the offsets become the supply hedge, if you like, the variability in the market. And I think that's got a lot of merit. Particularly as a politician, I want to see investment in low carbon infrastructure in Europe. That's what I think we need to get us out of recession. I think it will drive recovery. We need a new industrial revolution, actually, to get ourselves back into a growth pattern. And industrial revolutions are driven by energy change, and we need to shift our systems to low carbon, and that will, I think, deliver us to the growth we need. I'm not particularly keen on that money that we need desperately in Europe flowing to chemical plants in India and China for projects which could have been done at hardly any cost at all, really, if we're honest, if we put in regulations. So that's, I think, a sensible move to limit that offsetting at the moment. That's not to say I don't think we should be helping Africa and other least developed countries to develop, but we don't need to do that through necessarily the carbon market. There are other ways of doing it. So I'll end there. I think change is coming. I think politicians are alive to it. I'm sure there are many people in this room who've helped achieve that political change, because it's not just NGOs like ourselves saying this now. There's growing consensus amongst industry, growing consensus amongst participants in the scheme, as well as those who interact with it as financial institutions do. So I think time has come for it to change, and I hope that we'll see significant developments in the coming weeks.
That's great. Thanks very much, Brian. Plenty of food for thought there, the role of the ETS with other targets, offsetting, whether a carbon price or carbon price floor is politically possible. I just ask one question back to Christoph on this. You made the case for why a low price is perhaps a good sign in a market. It means that we're decarbonising cheaply. But what about the criticism that the cap is not set in line with anything realistic in terms of climate science?
I'm not a climate scientist, so I will not go into this discussion.
Yeah.
I think that we should be really blunt about the cost of reducing emissions, because ETS is a tool. I was a bit, maybe not surprised, but of course I'm always amazed by ETN saying that, if we don't have prices and things, your sector is not there and jobs are not there. But this is, of course, I understand. But I'm trying to say that ETS is not a tool in itself, a target in itself. It's just there to reduce emissions. And if we reduce emissions globally, cheaply, that's great. So, we started at a certain level, reducing from a certain level. The cap is there. Well, the features of cap and trade are as they are. I'm really trying to say that intervening in something that is sort of market designed by politicians, we don't have full information, and we cannot say it's one-off thing. We do it once, then in a couple of months there's a change in the market, and we say, oh yes, oops, well, let's intervene again. This will be just one-off. And I work in a political cabinet, but and maybe that's why I'm scared of ideas that politicians should rule the ETS. Let's leave it to the economists and
Just that.
Hold that thought. Okay, we'll take some time for questions now. We've got just over half an hour. Take John there, and then this lady just in front.
John Michael from RWN Palm. We've had a lot of talk on the platform about EU ETS driving investment, and that being as a primary reason as to why we need to have a higher price. I have to say that there's been substantial low carbon investment in Europe over the last few years. It is driven by renewable policy in 27 different member states with 27 or more different support mechanisms. If the likelihood is you keep fixing the EU ETS price, it still doesn't drive any investment because they're still largely driven by renewables policies. And what we need to look at, surely, if we want to see EU ETS driving investment, is convergence between renewable policy and the carbon market. And that has to be one of the critical issues if we're going to get this right.
Okay, hold that thought.
Mr. Grubb mentioned that...
sorry, can you say...
Oh, sorry, Liz Bosley, Consilience Energy Advisory Group. Mr. Grubb, you mentioned that one of the things that the EU ETS has achieved is a single line in your wiggly downward-facing graph. I would just like to point out that in terms of the CER market, that line is now shattered into a million pieces. And we're about to see it happen to the EUA as well. We're already seeing a premium being paid for EUAs that are guaranteed not to be Greek, because no one quite knows how Europe is going to react if Greece comes out of the euro. And having been up close and personal with the Hungarian recycled CERs debacle, you cannot rely on European policy to be rational or to take into account the good faith actions of market participants. But my point I'd like to make is that when it comes to intervening in the market, well, I've been involved with OPEC for years, and if Europe wants to try and intervene in the market, John, good luck to you. I'm not particularly hopeful. At the moment, the policy is to try and get some of these surplus EUAs off the market, and at the moment Poland is blocking it. If the UK and the other 26 countries mean business, then they can do it on their own account. The CRC is a huge missed opportunity. Why do we have separate CRC allowances? Why did we not implement the CRC requiring the companies to buy EUAs on the market, which are hugely in surplus, and would put the price up?
Okay, thanks very much, Liz. I'll come to Michael on that, also a big fan of CRC. Mike, do you want to jump on this first?
John's question.
We'll take the second question first, Michael.
I think it's actually looking entirely possible that if nothing is agreed at the European level, we will see a fractioning of the ETS. You made reference to Greece. The UK has kind of tried to set its own floor price, which is a bit of an odd thing to do in the European market, but it shows the thinking in countries which are really looking at low carbon investment, how you provide stability, etc. I'm just saying that I don't think that's a good way to go for all the reasons, I suppose, that you'd expect someone with some economics background to say. And sort of in relation to the earlier one as well, yes, convergence between renewables and ETS will be very useful, should be an objective, and no question, it shows that if you fix a constant price that industry can rely on, it's a far better tool for getting investment. But there's a lot of talk, and a big report about to come out from the Council of European Regulators, about the costs and the downside of having 27 different regulatory regimes for renewables, and the industry basically hunts around for the biggest subsidy rather than the most efficient renewable investment. So, you know, it's not a desirable outcome to have these things splinter with any member state going its own way at all. And that is why, you know, I guess focus at the European level. I think the suggestion on CRC, which I expect many in this audience would know as the what was originally called the carbon reduction commitment for large commercial enterprises, but that was carefully dropped. I'm inclined to agree it would have been an interesting link to consider the requirement to buy EUA allowances rather than by separate auctions, but that's probably a little bit away from the main topic here.
Yeah, just on John's point about renewables, you know, you're absolutely right. Of course, the investment is flowing and it's coming out of those national policies for renewables that are driven by the targets set at European level. But unfortunately, such is the nature of the beast, that isn't enough to get us necessarily on a downward reduction in carbon intensity, because what's actually been happening also is we've been switching out of gas and into coal. And that's obviously having an impact on our overall CO2 budget. So we need both. We need a strong carbon price and to drive us back towards the cleaner forms of fuel and away from coal, unabated coal. And we need renewables. Now, you know, there's a big debate going on in Europe at the moment, what we do for 2030. Do we set 2030 renewables targets? Do we set decarbonisation targets, which includes both CCS, renewables and nuclear potentially, in driving forward investment on that? But actually, if we had a functioning carbon market with a decent price, we wouldn't need to worry about that. That would do it for you. And one of the things that's been interesting is watching Oettinger shift over time as he's the energy commissioner, realising that actually he's being lobbied now more and more by the investment community and the people developing clean infrastructure. He's sort of he's shifting quite remarkably away from his instinctive belief that all carbon policy is bad because it impacts on heavy industry, towards seeing that actually heavy industry is even benefiting from this, because you don't make windmills out of cardboard. You know, that this is driving an industrial revival actually in some countries. So, so actually, you know, the carbon pricing, if it's done well and it's seen as politically sustainable, is the best mechanism, I believe. It's the way you get to the least cost and it's the least politically vulnerable.
I couldn't agree more. I think from a market participant's perspective, what is striking is that the pace of decision making as the facts change and the development of renewables, the success of renewables is a major fact, right? So the pace of decision making seems to be completely not in line with price development and market development. So I think I come back to my first message is that there seems to be this aversion or perceived aversion by policymakers and market participants would be against some well-informed central authority at the European level, for example, making decisions to remove a bit of supply here, a bit of supply there, as the facts change and as you get more observation that, for example, renewables really exploding in some countries. I think that is a misconception. Market players will welcome that, but obviously it comes with a governance, it comes with rituals. You need to have good economists, well-informed people, and they are appointed according to transparent standards. They are competent, and then they are careful with their communication, and they say, well, in line of what we see, okay, we're thinking of tightening the level of supply. I think market participants would welcome that, but that's not the style we've seen so far. And in particular, the decision-making, the pace of decision-making has been horrible.
Hold that thought. We'll take the two questions just there. Benny Heiser from the Global Warming Policy Foundation. I'm a bit surprised about the lack of international reality. Where we're discussing is if Europe is doing this on its own without realizing what is happening at the international level. And at the international level, we have the Rio Summit. We know that we have increasing problems with the developing world about the aviation policy and the ETS. We even know that the EU roadmap, the energy roadmap, essentially confirms that if there is no international agreement, Europe is not going to continue with its unilateral policy. So what I'm trying to get at, I'm trying to ask you is, aren't all the signals over the last 2 or 3 years that Europe is cooling on this issue, is not going to accelerate it? There's no political will, not just in Poland. Poland is just the scapegoat and the brave man out. We know that a lot of other countries are quite happy of what Poland is actually doing in preventing Europe from even doing more foolish things, going it alone. So isn't the reality that Europe, many countries in Europe, including this country, by the way, is cooling off and is actually trying to roll this back a little bit?
Okay, hold that thought. And Damien?
I'm going to go the opposite direction to Benny there. I'm Damien from the Sandbag Climate Campaign. I want to address a comment to Christoph to answer. I think you've sidestepped the fundamental question about scientific targets there, and I don't think it's fair to say I'm not a climate scientist. I think it's incumbent upon policymakers and policy advisors in this space to be familiar with what the climate science is telling us. Just from our own calculations, which are very conservative in this space, Europe has used up 60% of its carbon budget out to 2050 in just 20 years. If you don't want to trust us, the IPCC has talked about developed countries needing to take on 25 to 40% targets by 2020, and we're nowhere near that. But just holding aside the question of targets for a second, I just want to highlight that carbon budgets, both in the ETS and Kyoto, have a structural problem that if the targets are set inappropriately, they carry this legacy of allowances forward, of emissions rights to be used in the future. So there's an additional problem that we have to address there.
Okay, two questions there. I'll come to you in a minute, Christoph. Michael, can I just ask you about that, Benny's question about, it's all very well us sitting in this room thinking about tinkering to the ETS, but the rest of the world is not worried about any of the climate policies, and we're just shooting ourselves in the foot.
Well, I'm tempted to say that, as a researcher, I like to try and kind of keep a clear focus on what I think needs to be done rather than get buffeted by, current political moods. And obviously, that's one of the challenges of this issue, is that there will be political cycles. And I think one of the things that the industry most needs and the policy needs most to try and deliver is some consistency in which there is a major scientific component. To say, the nature of politics, things will swing around in moods and different regions, etc. What I think is, clearly, at the end of the day, we can't solve a global problem without most of the world doing stuff. Fine. Do you think most of the rest of the world is more likely to do stuff if Europe says, well, no, actually, it's all kind of too difficult, let's give up? Is that going to make other countries jump up and say, oh, well, we'll be more ambitious then? Of course not. There's actually a tremendous amount of countries looking at each other, how do we inch this forward, etc. What is, I think, very interesting is that if you wound back only 3 years, basically the European effort and most of the rest of the world was entirely focused on the US, the US Senate, the US Congress. That was, as we know, at Copenhagen, in effect, the outcome was shaped very, very strongly, almost entirely, by what did the US need in terms of a very light touch international law, and what did the US need from China, and that led to the outcome. The US probably couldn't deliver. What I find really interesting is that hasn't left the rest of the world to give up, say, oh, it's just too difficult. Obviously there's various stuff going on within states in the US. California has now legislated its cap and trade scheme. Australia has a cap and trade scheme legislated. Climate strategy doing well with Guangdong, a region which happens to have a bigger population, I believe, than the UK, on its cap and trade scheme. So we're seeing more emphasis upon bottom-up regions moving ahead as they see necessary, but with a great interest in what each other is doing, etc. So I thought it was a terrible time to give up on an effort, because it's in effect, rebuilding an international momentum towards a 2015 deadline that was agreed in Durban. Now, none of us know exactly what that can deliver. I think it is a factor in certainly the view I have, which is the problems we have with the EU ETS are unlikely to be resolved through a global deal and an associated post-2020 European target early enough to address the current problems that investors and others face. So hence, I'll look at other instruments. So I guess that's the way I see domestic efforts relating internationally.
Right, just on that, Michael's touched on globally, but within Europe, is that kind of political will to tackle some of these?
What's interesting is I think there's two things going on. There might well be a political cooling of talking explicitly about climate being the sole driver for this. There's an absolute shift in towards more talk about the need for industrial revolutions and investment in our energy infrastructure, job creation, all of that, which is underpinned also by a sense that in the long run it's going to be much more sustainable economically if we make use of non-volatile forms of energy, so not relying on fossil fuel prices, which are probably only going to go in one direction, but getting a certain degree of energy independence and security. So those political drivers when you add it to the climate driver, actually mean it's not cooling off at all. In fact, it's speeding up, even in those countries which in the international fora are saying we're not interested. And in the US, if you just watched what went on in UN and international conferences, you could get depressed, but frankly, they're pretty irrelevant. What's actually driving us now is domestic legislation. And I'm a part of the Green Globe Network, which did a survey recently, and there are now more than 16 countries who've got climate change legislation on their books, driving policy, driving investment, and there are more being added, and Michael's alluded to the fact that all of this, the most significant player is China. And China is not following the US pattern, it's explicitly said that. They don't want to follow the US model. They have their own reasons for wanting to take a more sustainable path, all to do with stability within their country. They have massive resource demands, and they need to find the most efficient ways of meeting them. They're moving ahead on every single modern energy technology you can imagine, and some we haven't even heard of yet. They will be in an export position. They already are in an export position in dominant sectors. Interestingly, in the US now, they're having trade wars over Chinese exporting of PV panels and wind turbines. So, whilst the US might be saying they don't believe in climate change for their own reasons, on the ground, they are very aware there's a race on, and that's a race towards the next generation of clean technology, and that's what's driving it. So it's not cooling off, it's heating up, and actually it's incumbent on the EU to just get with the programme and keep pace with it. And at the moment, because of the way it's structured, we are moving quite slowly, but we are, I think, just about in there in the game, and if we can move on the ETS and really sort ourselves out, then we'll be a big player too.
Christoph, what's your sense of one of the questions was that, or one of the questions said that Poland is the scapegoat for lots of criticism about policy. Do you get the sense that there are other countries who are just hiding behind Poland's veto?
I know it for a fact. Because I was part of the negotiation of the low carbon economy roadmap conclusions, and there are quite a few countries saying, well done, keep on going. And actually, it's
it's a reality.
Yeah,
it's a negotiation room. So I'm just trying to say that, of course, we realize that we still an odd man out, but there's a few countries in the EU that think that we at least trying to voice some concerns. On the science question, I fully agree with you. Actually, I think that science is actually on our side. I fully sign up to sort of all the research you put on the table, and we have to sort of adapt our policies. Still, we are responsible in the European Union for around 8% of emissions, and all the billions of the people in the world, huge part of them still do not have access to energy. And every single one of them wants to have energy for cooking. He or she want to drive maybe an SUV. So there's still a potential to grow in energy consumption, and we have to realize that. That's why we'll be saying, yes, let's fix ETS, but let's put an emphasis on global negotiations, because we have to have them on board when we sort of save the planet. We will not save the planet in the European Union. That's sort of a dream, a pipe dream. And of course, 2%, 2 degrees Celsius is a very ambitious target. And we already know that we will probably not meet that target. So maybe we should sort of discuss what could be done, and let's forget the ambitions. Let's try to have a reasonable solution. And this is where I really struggle with giving the leadership to the politicians, because the politicians rarely have a plan B. They invest all they have in what they promised or what they agreed. We should have a plan B. Following the evolutionary principle, we should, try and error. If we fail here, different policy, something better.
So is that saying we shouldn't have an ETS? Is that what the logical end of the position is? Or?
At this stage, ETS is our best bet.
Okay.
The ideal solution would be to have a carbon tax on EU borders, that would bring everyone on board.
Okay, Poland calls for EU-wide carbon tax. There we go. There's a question down here at the front, and then I'll take one of the hands at the back.
It's Prashant from Consumer Focus. We recently ran some deliberative fora across the UK, and one of the questions we asked was, we showed the electricity bills now and in 2020, and the effects of the carbon floor price and EU ETS. People were quite disappointed at the kind of very sharp rises in the kind of carbon tax and the effect on bills. Surprised that it was there at all. There's a lot of very low awareness of carbon taxes and energy taxes at the moment. There's a little bit of kind of less stability when they thought that the money would be reinvested into the energy system, renewables or energy efficiency. For us, those of us with the kind of economics bent, Michael, we understand and have quite a lot of sympathy for the idea of reserve prices for the auction, and especially across the EU level. But however, are there sort of two pretty critical issues, problems with it at the moment? I mean, politicians don't like it because it's a sort of a baby step towards fiscal union, so it scores negatively there. And many consumers don't like it because of the idea of a sort of stealth tax, in a way that these can be mitigated.
Hold that thought. And then the chat with the publisher.
Hi there, Elliot Whittington. I'm the director of the Corporate Leaders Group on Climate Change, which is, for those who don't know, it's a group of companies including Shell, EDF Energy, Tesco's, comes together around the business case for acting on climate change. And basically, I mean, I think there was a reference to we need to act in terms to save the planet. It's from those companies. It's very much there's a belief that the need to act comes from it being good business sense. I wanted to ask a question about the costs of not acting, because I think that's certainly in Michael's presentation and a few other points that came up, this need to unlock investment. And the longer that the situation goes on without clarity, the longer we go on without that needed investment, the longer we go without Europe being able to kind of generate a competitive edge in certain industries. And I wondered if, for those who are sort of suggesting that we don't need to find a way through the current situation, how else we should seize on that investment and make sure that we are charting a good economic course forward given the reality of climate change.
Okay, and we'll just take one more because we're running short of time. We'll take one more question down here.
This is Jessica Dell from Argus Media. This is a question for Christoph. You mentioned that with the negotiations on the low carbon roadmap that a few countries voiced their support for your opinion, and I was just curious of your expectations when the Commission releases their proposal on backloading, whether you think essentially you'll have that same situation where a few countries are also against the proposal, or just essentially how you see that playing out next month.
Christoph, do you just want to answer that question first?
Yeah, that was great. Yes, on the new policy initiative by the Commission. Well, I think that we probably will not have the same countries on board, and this is because there's a different battle going on. Some countries actually count on more revenues because they want to stuff the money into the budget holes. So nothing related to climate change, nothing related to climate policy, they just want to boost their revenues.
Okay.
That's perfectly rational for them to do so. And I think we ought to just remind ourselves that within the ETS as it stands, there is a specific clause that redistributes allowances from those countries with a higher than average GDP to those countries with a lower than average GDP, and that means Poland and the other accession countries, which means this is a redistributive policy that is in those countries' interests, that the value of those allowances should be higher. Now, Poland, Christoph, you come from a country that has got significant challenges, and I don't want to try and, actually do those down. Coal is the dominant energy source. You have a massive border with the Ukraine. Leakage is a much more real issue in Poland. But I think it's unfair to say that the policy hasn't been already adapted to try to take some of those things into account. And I think we've got to move forward on a positive agenda. You've already sedated, let's bring more sectors in, let's try and get the Ukraine in. Those are definite positive things we can move forward on together. But let's also accept that by increasing the price, you are going to benefit, and that will help invest in your energy infrastructure.
What about that? Coming back to the question.
Can I come back to this very quickly? I think that, certainly this kind of redistribution idea is a good one. Thing is that we, as a Ministry of Environment, have to face to the Ministry of Finance, say, listen, could you give us some of the proceeds you got? And the answer is very often, no. No, because we have problems with pensions, we have problems with infrastructure, so, simply they say, behind closed doors, bugger off.
We have exactly the same problem with the Treasury.
Yes, that's right. Yeah, how unlikely
The question was asked was largely political economy. Forgive me for a moment. I just want to outline an pure economic dimension to this, but it feeds in. We have politically created a market. Normal markets have, for those of you with a vague economics background, a supply curve and a demand curve. It looks something like that, and they kind of adjust as the price changes. In the ETS, the problem is that we've got a demand curve which is pretty steep because it's the difference between the cap that's set and actual emission trend, so it's very sensitive. And a supply curve which is rock vertical. Not surprised that you have a pretty unstable kind of price and a pretty unstable kind of system overall in terms of its price. In terms of options and what do you do about it, I'm not disagreeing with the set-aside, etc. debates. All I'm saying is they don't actually address that fundamental question of how can you induce greater stability into the system, because frankly, none of us have very good insight into what the European economy is going to do over the next 8 years. Right? So whatever we set aside, absolutely agree with Christoph, there's a real risk we'll have created a precedent to keep intervening more. I think setting up the governance for a kind of European central bank of carbon, I don't see it being the top of priority lists at the moment. But anyway, in effect, what you're doing with the sort of approach we're looking at, it's not the only one, but there has to be some answer to that fundamental design question, and there's another option touched in the Sandbag report, certainly. But the approach we took was take the supply curve that you've got, add in a reserve price, which basically means it look like that. In the real world, the price will not do that. The real price is you have greatly reduced the risk of holding on to allowances if the price is going down. Companies will also be looking forward to what comes post-20. You will actually start to create something that looks much more like a normal market pattern. And in terms of your question, Prashant, I think that the consumer voter involvement in this is crucial, and we know there's let's not pretend this bit is anything new. I mean, for a century we've had economists saying, oh, price is the efficient instrument, and public saying we don't want to pay prices unless we have, if it's previously been free. Somebody else should pay, something else should pay, don't say it. This is not new, right? But there are real issues, and I think that amongst those issues are, I think there's a real legitimate concern about the idea that people take action to reduce emissions, they don't actually end up reducing emissions. They've just saved some company money by reducing the pressure on supply in the trading system. And I think the sort of mechanisms we're talking about mean that actually the individual actions that everyone takes do a mix of slightly reducing the price and taking some allowances out of the system because less may come forward in the next round of auctions to the effects of reserve price or the other kind of mechanisms. So I think it starts to address that. And yes, actually, and I don't want to particularly sound heretical as an economist, but there is great theory behind the idea that the Treasury and all Treasuries hate hypothecation, earmarking. You raise money efficiently, you spend it efficiently, now the twain should meet. I don't actually think that applies in the context of something like this. We have needs for energy efficiency programs which reduce the impact of prices on consumers. We have needs for innovation. The scale of those programs are all linked to how serious we think the climate problem is. And it's entirely reasonable to say some share of these revenues should be towards helping those constituencies of both consumers and business adapt for a low carbon economy. And I think that's been one of the big missing bits of the political economy of this issue.
Just from somebody working in the markets in this point of view, there's been talk about different policy instruments. One of the questions said, if we didn't have an ETS, what would that matter to people working in your position?
Well, does it matter, you know, whatever the rules are, that you're
the rules are important, and the way you implement them, you know, it's also very important. But the general picture is, if there is a clear framework, whatever it is, it could be the EU ETS or something else, you know, money will get invested because private sector, you know, participants are keen to invest their money. So that's a basic kind of premise. In the EU ETS, there are different ways to affect it. Clearly, when you have a carbon floor like in the UK today, it's very important to understand, I think the price of electricity is very critical here. When we look at the forward curve of power prices in the UK, the price of EUAs has become irrelevant. And the market, the way the market price power in the UK for the years 2016 or 15, you take the price of gas, you add the carbon floor, and then you put a small margin, that's the price of power. And so I think it's very important that an initiative like the carbon floor makes the EU price completely irrelevant. Because, you know, whatever the price could be €1, well, you need to take the carbon floor anyway, the price could be €5, so it's relevant. So I generally believe such an initiative is probably not good for the market, because you've got more and more market participants not affected by the market price, and so the liquidity will reduce. By contrast, saying we're going to put a reserve price in the government auction is definitely going to have an effect, because at some point the supply is not available at 6, and then you need to jump to, let's say the reserve price is 12, whatever the price, right? So that's going to have an healthier effect on the market price. On the relevance of the market to economic decisions. So I think the particular mechanisms of how you go into the market and intervene, I think that is critical. Now, there could be a political decision to say, the EU ETS, you know what, it was a nice infrastructure, but we're not going to keep it, we're going to go to taxes. You know, is money still going to be invested in the green economy? Absolutely, yes. You know, whatever the incentive mechanism, people are going to act on that. It would be a shame though, because I think it's a very nice and efficient and well-conceived infrastructure, which has required, you know, years of investment.
Okay. Just very quickly, we haven't got time for any last questions, but just a very quick run round. Will the ETS still be in place in 2030?
Absolutely, yes, because it's a directive that doesn't have a sunset, as I said. It's tracking down the 1.74% per year, reducing emissions allowances availability. I can't see anything other than more ETSs being created in other countries. In fact, by the time we get to 2030, I wouldn't be surprised if we didn't have a pan-Asian carbon market with links to the European market and an American or an America's market with countries like Mexico and others starting to introduce their schemes. So not only will we have ETS, we will have many other ETSs, and there will be links between them, and that will be the most efficient system we can imagine.
I think yes, but it will be set in both a much deeper understanding of the role of price in relation to other things and the macroeconomics of issue, and a much more sophisticated governance structure.
Absolutely, the ETS will be in place in 2030. I agree that there will be other regional schemes, all interconnected. And I think the carbon price, you know, I'm optimistic that the carbon price will become a real economic indicator, followed like oil. I generally believe so. I think, though, from everything I've observed, you know, it's a market I've loved, and you know, we've been trading in it, you know, for a number of years. It's going to be a rocky road. It's you can already see from the past few years, you know, phase 1, EUAs have got to 0. You know, we've had our fair share of hiccups. So I think it's going to be a rocky road, but I'm optimistic.
I think it will be in place, although its scope and features will be totally different, and they will depend in 2030 mainly on whether there is a global lead or not.
Okay. So we can all reconvene in 18 years' time and see whether they're all right or wrong. I'd just ask you to thank our panel for a wonderful discussion.